On July 4 of 2025, buried inside one of the longest bills Congress had passed in years, Washington created a brand new tax break aimed straight at your generation, and almost nobody read the line that did it. This is the filing season. It finally takes effect. If you are 65 or older, or you will turn 65 before this year is over, there is now a $6,000 deduction sitting in the tax code with your name on it. By the time this video ends, you will know whether you qualify for the full amount, part of it, or nothing at all, because the whole thing comes down to a handful of numbers that most people have never actually checked on their own return. Here is why this matters right now today and not next year. The law is called the One Big Beautiful Bill Act, and according to the IRS, the new senior deduction applies to tax years 2025 through 2028. That means the very first return where it shows up is the one being filed this season. Miss it, and you do not get a second chance at that year. Claim it wrong, or assume you get it when the fine print says you do not, and you have built your plan on a number that was never there. You have probably already heard something about this. Maybe a neighbor told you Social Security is not taxed anymore. Maybe a headline said seniors just got a huge break. Maybe someone at church said the government finally did something for retired people. Some of that is true. A surprising amount of it is not. The Social Security Administration itself put out a statement that it later had to walk back. And we are going to get to exactly what it said and why it was wrong, because that one piece of confusion is costing people real money and real peace of mind. Think about what a deduction like this actually touches. It is not a small rebate. For a married couple where both people are 65 or older, we are talking about up to $12,000 coming off the income the government is allowed to tax. On a fixed income, that is not a rounding error. That is groceries. That is a Medicare supplement premium. That is the difference between dipping into savings this year or leaving it alone. And this is the part almost every cheerful headline skipped. There is a line drawn through the middle of this benefit. Above a certain income, it starts shrinking. Past a higher number, it disappears completely. Below a certain income, strangely, it can be worth nothing to you at all, even though you are exactly the person it was supposedly written for. 3 different groups of older Americans, 3 completely different outcomes from the same single provision. So the question is not really whether the deduction exists. It does. The IRS has confirmed it, posted the rules, and even built an eligibility checker for it. The real question, the one that decides what lands in your bank account, is which side of every one of those lines you happen to fall on. That is what nobody explained to you. That is what we are going to walk through, slowly and in plain English, one number at a time. Stay with me, because near the end there is a date already circled on the calendar that changes how you should think about all of this. And if you only take one thing away from the next 40 minutes, it will be that. Let us start with what this actually is, because the name alone tells you almost nothing. The law is the One Big Beautiful Bill Act, signed on July 4 of 2025. It is enormous, touching everything from business taxes to workers to families. Tucked inside it is one provision written specifically for older Americans, and that provision is what everyone has been calling the senior bonus deduction, or the $6,000 deduction. Here is the first thing to understand, and it is the thing most people get wrong from the very beginning. This is a deduction, not a check. Nobody is mailing you $6,000. A deduction lowers the amount of your income that the government is allowed to tax. So the actual dollars it saves you depend on your tax bracket. According to Kiplinger, that is exactly why 2 people can both qualify for the same $6,000 deduction and walk away with very different savings. The deduction is the same. The tax you avoid is not. The second thing to understand is that this sits on top of what you already had. Older filers already get an extra standard deduction just for being 65 or older. For 2026, that additional amount is $2,050 for a single filer and $1,650 per qualifying spouse for a married couple, according to reporting on the IRS figures. This new $6,000 deduction does not replace that. It stacks. So a 65-year-old is now looking at their regular standard deduction, plus the old age-based add-on, plus this new senior deduction, all in the same year. That is a meaningful pile of income the government simply does not get to reach. The third thing, and this is the part that quietly makes it useful to far more people than you would expect, is that you do not have to itemize to get it. This is important, so let me slow down. For decades, a lot of the best tax breaks only helped people who itemized, meaning they added up mortgage interest, charitable gifts, and the rest, and only benefited if that total beat the standard deduction. Most retired people do not itemize. They take the standard deduction and move on. According to the IRS, this new senior deduction is available whether you itemize or take the standard deduction. That single design choice is what opens the door to ordinary retired filers who would normally never see a benefit like this. Now, why did Washington do this at all? The political story is straightforward. There had been years of promises to stop taxing Social Security benefits. That is a popular idea, and it comes up in almost every election. But actually repealing the tax on Social Security is complicated and expensive, and it runs straight into the rules Congress has to follow when it writes a budget bill. So instead of repealing that tax directly, lawmakers reached for something they could pass, a temporary, income-based deduction aimed at the same group of people. It gets to the same neighborhood by a different road. And as we will see, taking that different road is the entire reason for the confusion that followed. According to the Peter G. Peterson Foundation, which studies the federal budget, this provision was scored as a real cost to the government, which tells you it is a real benefit flowing to real people. This is not a symbolic gesture. Money genuinely changes hands, or more precisely, money genuinely stays in the hands of the people who qualify. So that is the shape of it. A brand new deduction, worth up to $6,000 per person, stacking on top of everything you already had, available even if you never itemize, aimed at older Americans and born out of a promise about Social Security that it does not quite keep. Hold on to that last part because it is coming back. First, the number itself and how much of it is really yours. $6,000 per person. That is the headline, and for once the headline is accurate as far as it goes. According to the IRS, an individual who is 65 or older may claim an additional deduction of $6,000 for the years 2025 through 2028. Now watch what happens with a married couple, because this is where people either gain a lot or leave money behind without realizing it. If you are married and both of you meet the age requirement, both of you can claim the deduction on a joint return. That is $6,000 for one plus $6,000 for the other, for a total of $12,000. But read that carefully. Both of you have to qualify. If one spouse is 67 and the other is 61, only the 67-year-old gets the deduction that year. The couple gets $6,000, not $12,000, until the younger one also crosses 65. A lot of couples where there is an age gap are going to be surprised by that, so if that is your household, mark it now. Let me make the number real, because $6,000 off your taxable income is an abstraction until you turn it into dollars in your pocket. Say you are a retired couple, and your income puts you in the 12% federal bracket, which is common for people living mostly on Social Security and a modest pension or withdrawal. If both of you qualify, that $12,000 deduction, at 12%, is roughly $1,440 you do not pay. If you are a single filer in that same bracket with the $6,000 deduction, it is roughly $720. That is why Kiplinger stresses that the savings vary by income. The deduction is a fixed size. What it is worth to you flexes with your bracket. Now move one bracket up, because plenty of retired households land there once you count a pension, some account withdrawals, and the taxable slice of Social Security. In the 22% federal bracket, that same $6,000 deduction is worth roughly $1,320 to a single filer, and the $12,000 version is worth about $2,640 to a couple where both qualify. Same deduction on paper, nearly double the real savings, purely because the income sits in a higher bracket. This is the single most misunderstood thing about deductions in general, and Kiplinger keeps hammering it for a reason. When a neighbor tells you what they saved, their number tells you almost nothing about yours, because you may be standing in a different bracket entirely. The only figure that matters is what it does on your own return. Here is a question worth sitting with for a second. What would an extra $720 or $1,440 a year actually do in your budget right now? For some people, that is a month of groceries. For others, it is the annual cost of a prescription. For others, it is simply money that stays invested instead of getting pulled out. The point is that this is not play money. It is the kind of number that changes a real decision. But notice something I just slipped in, and I did it on purpose. Every one of those examples assumed you had enough taxable income for the deduction to bite into. That assumption is doing a lot of quiet work, and for a whole group of older Americans, it does not hold at all. We will come back to that, because it is one of the cruelest twists in this entire law, that the people with the least can get nothing from a break sold as help for seniors. For now, hold the clean version in your head. $6,000 per qualifying person, up to $12,000 for a couple where both qualify. Worth more if you are in a higher bracket, less if you are in a lower one, and worth nothing extra if you had no tax to reduce in the first place. That is the number on the table. The next question is the one that decides whether you are even allowed to reach for it. Who does Washington actually count as a senior here? The answer is more specific and more strict than you might assume. You would think the age rule for a senior deduction would be the simple part. Mostly it is, but the details are exactly where returns go wrong, so let us be precise. According to the IRS, you must be 65 or older by the end of the tax year to claim the deduction. Read that as the last day of the year, not your filing date next spring. So for this year, the test is whether you have turned 65 by December 31. If your 65th birthday lands in the final days of December, you are treated as 65 for the whole year for this purpose. If it lands in early January of next year, you do not get the deduction on this year's return, no matter how close you were. One birthday a few days apart, two different tax outcomes. Now the requirement that trips up couples. If you are married, you generally must file a joint return to claim this deduction. According to reporting on the rules, married couples who file separately do not get it. That matters because some couples file separately for specific reasons, sometimes tied to medical expense thresholds, sometimes to income-based repayment on student loans, sometimes to keep finances divided after remarriage. If that is you, filing separately could quietly cost you the entire deduction, $6,000 or $12,000 of it. That is not a reason to change how you file on your own hunch. It is a reason to have someone run both ways and show you the actual difference before you sign anything. There is also an identification requirement worth naming. The law ties the deduction to having a valid Social Security number on the return. This was written in deliberately, and it means the deduction is aimed at people filing with a Social Security number, not an alternative taxpayer identification number. For most people watching this, that box is already checked, and you will never think about it. It is in here because it is part of the actual rule, and I promised you the real fine print, not the polished version. Let me pause on the age point because there is a myth attached to it. A lot of people hear senior deduction and assume it kicks in when you start collecting Social Security or when you hit your full retirement age. It does not. This deduction is tied to one thing and one thing only, being 65 or older by the end of the year. You could be 63, fully retired, collecting Social Security early, and you still do not qualify yet. You could be 66 and still working full-time, and you do qualify, as long as the income rules we are about to cover do not phase you out. Retirement status is irrelevant here. Age is everything. Here is a question I want you to actually answer in your own head. How old will you be on December 31 of this year? Not next year, this year. Because that single fact, more than your retirement date, more than when you claimed Social Security, is the first gate you either walk through or you do not. If you are 65 or older by then, you clear the age test. If you are 64, you are 1 year early, and this is a benefit to plan around, not to claim yet. Clearing the age gate, though, is only the first step. Even if you are comfortably past 65, there is a second line in the law that can shrink this deduction down to nothing, and it has nothing to do with your age and everything to do with a single income number. That line is where more people get caught than anywhere else, so let us walk it carefully. Here is where the clean $6,000 story starts to bend, and where you find out which version of this law applies to you. The deduction is income-based. According to the IRS and reporting from CNBC, it begins to phase out once your modified adjusted gross income passes $75,000 if you are single, or $150,000 if you are married filing jointly. Below those numbers, you are in the clear, and you get the full deduction you qualify for by age. Above them, the deduction starts to shrink. Let me explain modified adjusted gross income without the jargon, because this is the number everything hinges on and most people have never looked at it directly. Start with your total income for the year. Wages if you still work, withdrawals from traditional retirement accounts, pension payments, interest, dividends, capital gains, the taxable part of your Social Security, all of it. Adjust it by a few specific items, and that is roughly your modified adjusted gross income. For most retired people, it is simply the big picture number of everything that came in that the tax code counts. The important thing is that it is not just your Social Security. A large withdrawal from a traditional retirement account in a single year can push this number up fast. Now the phase-out itself. According to the rules, above the threshold your deduction is reduced by 6% of the amount your income runs over the line. Let me turn that into something you can actually see. Say you are single, and your modified adjusted gross income is $85,000. That is $10,000 over the $75,000 threshold. 6% of $10,000 is $600, so your $6,000 deduction drops to $5,400. Push your income to $95,000, and you are $20,000 over, which cuts $1,200, leaving a $4,800 deduction. You can feel it melting as the income climbs. And there is a point where it hits zero. According to the reporting, the deduction is completely gone once a single filer's income reaches $175,000, or a joint filer's income reaches $250,000. Above those numbers, the senior deduction simply is not there for you, regardless of age. You crossed 65, you did everything right, and the income line still shut the door. Let me run the couple's version all the way through, because that is where the real money sits and where the phase-out does the most damage without anyone noticing. Picture a married couple, both over 65, filing jointly, both qualifying, so on paper they are looking at the full $12,000. Their threshold is $150,000. Say their modified adjusted gross income for the year comes in at $170,000. That is $20,000 over the line. At 6%, the reduction is $1,200, so their combined deduction falls from $12,000 to $10,800. Push it to $200,000 of income, and they are $50,000 over, which cuts $3,000, leaving $9,000. Keep climbing toward $250,000, and the entire $12,000 deduction is gone. Notice how a single large withdrawal, one big capital gain, or a well-meant Roth conversion done all in 1 year can be exactly the thing that pushes a couple across that line and quietly shaves thousands off the deduction they assumed was locked in. Here is why this matters more than it looks, and it is a point I want you to really hear. Your income in retirement is often more controllable than you think, because you frequently choose how much to pull from retirement accounts in a given year. That means this threshold is not just a passive fact you discover in April. For some people, it is a line you can plan around across the whole year. CNBC pointed out that the senior deduction creates genuine planning opportunities for exactly this reason. If a large withdrawal would push you over a threshold and shrink the deduction, spreading that withdrawal across 2 years, or timing it differently, can be the difference between keeping the full break and watching part of it evaporate. I'm not telling you what to do with your accounts. I am pointing at the lever and telling you it exists, because most people do not even know it is there. The single biggest mistake here is treating your income number as something that just happens to you, when for many retired people it is partly a set of choices made over the year. So now you have two gates: age, which you either clear or you do not, and income, which decides how much of the deduction survives. But there is a third thing tangled up in all of this, and it is the piece that generated more confusion than anything else: the idea that Social Security itself is now tax-free. That story is not quite true, and the mix-up started at the top. This is the part where I have to correct something you have almost certainly heard, and I want to be careful and fair about it, because the confusion did not come from nowhere. It came from the government itself. When the law passed, the Social Security Administration sent out a message stating that the bill, and I am quoting the reporting here, includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries. That statement went out widely. People read it and reasonably concluded that Social Security was no longer taxed. The problem is that it was not accurate, and it later had to be walked back. Here is the truth, stated plainly. The One Big Beautiful Bill Act does not change how Social Security benefits are taxed. It makes no changes to the Social Security program itself. According to the reporting on this, the same formula that has governed Social Security taxation for about 40 years is still in place. Depending on your income, anywhere from 0 to 85% of your benefits can still be taxable, exactly as before. The thresholds that decide that were not raised. Nothing about the Social Security tax rules was rewritten. So what actually happened? Instead of touching Social Security's taxation directly, Congress created this separate senior deduction. It is a deduction against your overall income. Because it lowers your taxable income, it can, for many people, indirectly reduce or even wipe out the tax they would have owed, including the tax tied to their benefits. But it does that from the side, by shrinking taxable income in general, not by declaring Social Security off limits. The end result can feel the same for some people. The mechanism is completely different, and that difference is not just academic, as you are about to see. Now here is the number that got buried under the confusion, and it is a real one. According to an analysis from the White House Council of Economic Advisors, with this new deduction in place, only about 12% of seniors will pay taxes on their Social Security benefits. That is a genuine and significant shift. For a great many older Americans, the practical result is that their benefits end up untaxed. So the spirit of the promise, less tax for seniors, largely landed. It just did not land the way the headlines said, and the way it landed is exactly why it does not help everyone. Why does the distinction matter to you personally? Two reasons. First, because a deduction can phase out and Social Security's tax rules do not. Since the relief comes through an income-based deduction, people above those income thresholds we discussed get less of it, or none. If the law had truly eliminated the tax on benefits for everyone, income would not matter. Because it works through a deduction instead, income matters enormously. Second, because this deduction is temporary, and the underlying Social Security tax rules are permanent. When this deduction expires, and it has an expiration date we are going to get to, the old Social Security taxation is still sitting right there, unchanged, waiting. There is one more layer to this that the experts keep flagging, and it is the quiet cost of doing relief this way. The Center for Retirement Research points out that because this arrives as an income-based deduction with its own phase-outs and its own age rule, it actually adds complexity to the tax picture for older Americans rather than simplifying it. A true repeal of the tax on benefits would have been simple to understand, everyone treated the same. What we got instead is a benefit you have to qualify for on age, then keep by staying under an income line, then remember expires on a schedule. That is three moving parts where a repeal would have had none. And the researchers are blunt about the bottom line, that fewer than half of older Americans will benefit from it at all. So the honest framing is not that Washington fixed the tax on Social Security. It is that Washington created a temporary, income-limited workaround that helps a lot of middle-income seniors right now, leaves out both ends, and adds a layer of rules everyone now has to track. So if someone tells you Social Security is not taxed anymore, you now know the honest answer. For most beneficiaries, the tax effectively goes away for now, because of a separate temporary deduction, not because the tax on benefits was repealed. That word, temporary, is going to matter a great deal, But before we get to the clock, we have to talk about the people this break skips entirely, because they are not who you would guess. You would assume a tax break for seniors helps the seniors who need it most. This is the moment to set that assumption down, because the way this deduction is built, some of the people it skips are the ones with the least, and that is not an accident of bad luck. It is baked into how a deduction works. Start with the group that surprises everyone. The lowest income seniors often get no benefit from this at all. Here is why, and it is worth understanding because it feels backwards until you see the mechanics. A deduction only helps you if you have taxable income for it to reduce. Many lower-income older Americans already owe no federal income tax because their income is already fully covered by the regular standard deduction and the existing age-based deduction they get for being 65 or older. According to the Center for Retirement Research, a large share of older Americans already pay no federal income tax at all. If you already owe zero, a new deduction cannot lower your tax below zero. There is nothing left to reduce. So the person living mostly on a modest Social Security check, the person this was supposedly designed to protect, may see exactly nothing from it, because they were already not paying the tax it erases. Sit with how strange that is. The break is worth the most to a comfortable retired couple in a middle bracket with a healthy pension and account withdrawals, and worth nothing to the retiree scraping by on benefits alone. That is not a flaw someone forgot to fix. It is simply what happens when you deliver help through a deduction instead of a direct payment. Deductions reward people who have taxable income to shield. People below that line fall right through it. The second group left out is everyone under 65. We covered the age gate, but it belongs here too because it is one of the clearest exclusions in the law. If you are 63 and retired, living on savings and early Social Security, you might feel every bit as much a senior as your neighbor across the street. The tax code does not care. 65 by year end or nothing. There is no partial credit for being close. The third group is higher income seniors, and we already walked the phase out, so you know the shape. Past $175,000 of income for a single filer, or $250,000 for a couple, the deduction is fully gone. You can be 70 years old and see none of it because your income sits above the line. And there is a quieter fourth group, the couples who file separately, who, as we covered, generally lose access to the deduction entirely. Here is the honest summary, and it is a sharper version of something the Center for Retirement Research and others have pointed out. Fewer than half of older Americans will actually benefit from this. Let that land. A break announced as help for seniors reaches under half of them and misses both ends, the lowest incomes because they owe nothing already, and the highest incomes because they are phased out. It lands squarely in the middle. So which group are you in? That is not a rhetorical question. Age, income, filing status. Run yourself through those three honestly, and you will already know more about your own situation than most of the people repeating the headline. And once you know you qualify, the next question is the practical one. What do you actually do about it on your return? Let us get concrete about how this shows up on a real return, because knowing you qualify and knowing what to do with it are two different things. The good news, and it is genuinely good, is that this is not a complicated form you have to hunt down and fill out by hand. According to the IRS, the deduction is available to eligible taxpayers whether they take the standard deduction or itemize, and the IRS has published guidance and even built a tool to help you check your eligibility for the enhanced deduction. So the mechanics are designed to be reachable by ordinary filers, not just by people who pay for sophisticated tax help. If you use tax software or a preparer, this is largely a matter of your age and income being entered correctly so the deduction is applied. That sounds obvious, but it is exactly where small errors creep in. If a birth date is entered wrong or a spouse's age is off, the software may not apply a deduction you are entitled to. So the single most useful thing you can do is check that the deduction actually appears on your return before you file. Look for it. If you qualify by age and your income is under the threshold, that deduction should be reducing your taxable income, and you should be able to see it do so. Here is a practical point worth acting on. When your return is prepared this year, ask one direct question. whether the new senior deduction was applied and for how much. If the answer is a blank look, that is a signal to slow down and make sure nothing was missed. You are allowed to ask. It is your return and your money. It is worth knowing that the IRS did not leave people to guess on this. According to the IRS, the agency published guidance for the 2026 filing season aimed specifically at seniors and built an online tool to help you check your eligibility for the enhanced deduction before you file. That is unusual and it is useful. If you are not sure whether your income clears the threshold or whether your age qualifies you this year, that checker is a free place to get an answer straight from the source rather than from a headline or a neighbor. Use the official IRS material as your anchor and treat everything else as commentary on top of it. One more practical note on records. Because the deduction turns on your age and your modified adjusted gross income, the two things that decide it are your date of birth, which never changes, and your income for the year, which you can estimate before December ends. That means you do not have to wait until spring to know roughly where you stand. Late in the year, before the calendar closes, you can look at what your income is shaping up to be and know whether you are comfortably under the threshold, sitting right on the edge, or already phased out. Knowing that in November is far more useful than discovering it in April, because in November you may still have choices, and in April the year is already closed. Now the planning piece, and this is where people who pay attention separate themselves from people who just file and hope. Because the deduction phases out based on income, and because retired people often have real control over their income in a given year, this deduction becomes something you can plan around across the whole year, not just something you discover at tax time. CNBC specifically framed the senior deduction as creating planning opportunities for this reason. Consider a few situations where that control shows up, and I am describing what some people are weighing, not telling you what to do. Some people are looking at the timing of withdrawals from traditional retirement accounts, since a very large withdrawal in one year can push income over a threshold and shrink the deduction, while spreading it can preserve more of the break. Some people are looking at the timing of capital gains, since selling an appreciated asset all in one year raises income for that year. Some are thinking about how a Roth conversion, which adds to taxable income in the year it happens, interacts with the phase-out. In every one of these, the through line is the same. Income is often a set of timing choices, and the deduction rewards keeping that number under the line. Notice how the frame keeps shifting from you should to some people are considering. That is deliberate, and it is important. Nobody watching this should rearrange their retirement accounts because of a video. What you should take away is that the lever exists, that the threshold numbers are $75,000 single and $150,000 joint where the phase-out begins, and that this is worth a real conversation with someone who can see your entire picture before you make a big move. There is one more feature that makes this deduction unusually friendly, and it is worth repeating because it is so easy to miss. You do not lose it by taking the standard deduction. Most retired people take the standard deduction. In the old world, that meant a lot of tax breaks were simply out of reach. Here, according to the IRS, the standard deduction filer gets the senior deduction too. That is the design choice that turns this from a break for people with tax advisors into a break for ordinary retired households, at least the ones who fall inside the age and income gates. Which brings us to the single most important thing about this entire deduction, the one detail that should shape how you think about every decision around it. It does not last. Everything we have talked about, the $6,000, the $12,000 for couples, the way it quietly takes most seniors off the hook for tax on their benefits, all of it comes with an expiration date that is already on the calendar. According to the IRS and the reporting across the board, the senior deduction applies to tax years 2025 through 2028. After 2028, unless Congress acts to extend it, it goes away. This is a temporary provision, not a permanent feature of the tax code. 4 tax years. That is the window. The one being filed this season is the first of them, which means the clock is not just ticking in the future, it has already started. Let me be clear about why a temporary tax break is a different animal from a permanent one, because this changes how you should treat it. A permanent break is a floor you can build on. You can assume it will be there in your planning for years to come. A temporary break is a window you either use or watch close. According to the Peter G. Peterson Foundation and others analyzing the provision, its temporary nature creates real uncertainty for retirement planning, because you cannot safely assume the same rules apply 5 years out. Here is the practical consequence, and I want to frame it as a question rather than advice. If you know that a particular tax benefit is available for a limited set of years and then likely disappears, does it change how you sequence income and withdrawals during those years? For many people, the answer is yes, and this is precisely the kind of thing to raise with a qualified professional who can look at your whole timeline. Some people are thinking about which years to realize certain income while this deduction is active, because doing something during the window while the deduction can shield it is different from doing it after the window closes. Again, that is a conversation to have with someone who sees your full picture, not a decision to make off a video. And do not forget what is sitting underneath all of this. We established earlier that this law did not change how Social Security is taxed. It layered a temporary deduction on top. So when this deduction expires after 2028, the underlying Social Security taxation rules, the same ones that have been in place for about 40 years, are still there, completely unchanged. If nothing is extended, the relief many seniors feel right now could simply switch off, and the old tax treatment would be waiting exactly where it always was. That is the quiet risk baked into doing it this way instead of a permanent repeal. There is also a broader uncertainty worth naming honestly. Tax law is written by Congress, and Congress changes. A future Congress could extend this deduction, make it permanent, let it expire, or replace it with something else entirely. Nobody watching this and nobody making this video can tell you which of those will happen. What we can tell you is what the law says today, which is that this benefit is scheduled to run through 2028 and then end. So here is the honest through line of this whole thing. Right now, for the next handful of tax years, a lot of older Americans in the middle of the income range have a real and meaningful tax break available to them. It is worth understanding, worth checking that you are actually getting, and for some people worth planning around while it lasts. But it is borrowed time, not a permanent gift. Treat it that way. Which leads us to the last thing, what to keep your eye on from here. So where does this leave you, and what should you actually watch from here? First, watch the calendar around your own filing this year, because this is the first year the deduction is live. If you are 65 or older by December 31, and your income is under the phase-out thresholds, make sure the deduction actually appears on your return. Do not assume. Look for it, or ask the person preparing your taxes to confirm it was applied and for how much. This is the single most concrete thing in this entire video, and it is entirely within your control. Second, watch the income thresholds if you are anywhere near them. The phase-out begins at $75,000 for single filers and $150,000 for joint filers, and the deduction is fully gone at $175,000 and $250,000. If your income lives in that zone, this is the year to understand that the timing of withdrawals, gains, and conversions can move you across those lines. Not to act rashly, but to have the conversation before you make a large move. Third, and this is the big one, watch 2028. That is the year this deduction is scheduled to expire. Between now and then, pay attention to whether Congress moves to extend it, make it permanent, or let it lapse. Watch the approved, reliable sources for that, the IRS for the official rules, and outlets like Reuters, CNBC, AARP, and Kiplinger for what lawmakers are actually doing. A benefit with an expiration date is a benefit with a deadline attached, and deadlines are worth tracking. And fourth, watch the language people use around this, including official language, because we saw in this very story that even the Social Security Administration put out a statement it had to walk back. If you hear that Social Security is now tax-free, you now know the more precise truth. The tax on benefits was not repealed. A separate, temporary, income-based deduction was created that takes most seniors off the hook for now. Those are not the same thing, and the difference is exactly what decides whether the relief lasts. Let me leave you with the honest shape of it one more time, because it is easy to lose in the noise. Washington created a genuine tax break for older Americans, worth up to $6,000 per qualifying person and up to $12,000 for a couple where both qualify. It stacks on top of what you already had. It reaches you even if you take the standard deduction. For most seniors, it effectively removes the tax on their Social Security benefits for now. And yet it quietly leaves out three groups: the lowest income seniors who already owed nothing, anyone under 65, and higher income seniors phased out at the top, so that under half of older Americans actually benefit. And all of it is scheduled to end after 2028. The people who come out ahead here are not the ones who heard a headline and assumed it applied to them. They are the ones who checked three numbers: their age, their income, and their filing status, and then made sure they actually claimed what they were owed while the window is open. This video is for informational purposes only and does not constitute financial, legal, or tax advice. Laws and policies change. Always consult a qualified professional before making any financial decisions.